Okay, welcome back to my Vanguard portfolio update now for the month of September, and we're going to go through everything in my stocks and shares ISA and my self-invested personal pension, as usual, as we always do. Now, it's been an interesting 4 weeks in the stock market, as it always is. There's been lots that's already happening, and just before we jump into the portfolio, why don't we have a look quickly at what's been going on in the main markets around the world. Jumping across the pond first, let's have a look at the S&P 500 to see how kind of the market has been going generally. Now, quite interestingly, this month it's actually up 1.8% at the time of filming this video. Everything can definitely change in the next couple of days as I put this one on YouTube. But one thing's quite interesting, and I wanted to point this one out rather than pick out kind of any individual standout companies, was September is typically and has been the worst performing month in the stock market. Now, let me just put this chart up on screen for you now and you can have a look for yourself. So since 1928 until today, September has been one of the worst months. And as you can see, the average decline in September is negative 1.1%. Now, interestingly, we're up 1.8%, which puts us a huge swing away from where we might think we should be. Now, all this really shows us is that past performance is definitely not a reliable indicator for what we're going to do moving forward. And also, it does show the riskiness of kind of looking back at that past data thinking, if I sell out during the summer and maybe buy back in September and wait till everything hits low, I can make loads of money. It doesn't necessarily work like that. But I've got no doubt there'll be plenty of people out there who probably tried to time the market and unfortunately have probably lost themselves a lot of money. Now, saying that, we've still got a couple of weeks left until the end of the month. So really, anything can happen. But a really interesting stat there and something you kind of think of, good to know, but would I base any of my investing decisions on that one? Probably not. In terms of any companies worth paying attention to this month, some of the biggest news, I would say the latest IPO from Arm, the company which was owned by SoftBank, who designs those small low-powered computer chips, went live. It has done pretty well. Now, it did have a fairly successful IPO, about as successful as you can get, certainly for a 2023 standard. You can see here, I'll put the last few days worth of charts up on screen. It's only been live not for very long, only just a week as we go and film this video. But as you can see, it had a pretty good first day, but now it's sat really around level, so it's kind of given back those gains, but at least it didn't plummet at all, and traders have been quite excited. In fact, on the day of the IPO, lots of other stocks as well, especially in the tech sector, did see a bit of a boom. But then they also saw a bit of a drawdown the next day as well. So good old stock market doing what the stock market does. Now, sticking with IPOs and new companies coming to market, let me just show you this on screen now about how many different companies so far in 2023 have actually been brought to market and how that compares at least across the last 20 years or so. And what you'll see on screen now is quite interesting that 2020 and 2021 certainly were insane for new IPOs. And you can kind of imagine why. Lots of free money, really, really low interest rates, money being thrown around left, right, and center. And certainly we saw lots and lots of those SPACs, didn't we? Where essentially they would be these shell companies on the stock market and then they would absorb or buy or acquire another company and take them public. Lots of people got very excited. Some people would have made lots of money, but other people would have lost a huge amount as well. Lots and lots of those companies, huge hype, huge excitement, weren't making any profit and probably won't last much longer. Now, as you can see, we still do have a little bit of time left in 2023, but it will be interesting to see how this ends up comparing. But it is looking to be one of the most muted and one of the most kind of poor years for IPOs moving forward. Quite interesting just to have a look of what's been going on in the last few years. Now, quickly, more closer to home, let's have a look at the FTSE 100 and just have a look how local markets are doing. And actually, for the first time, I think, in a portfolio update, I can actually say that the FTSE 100 has had a really interesting month finally. Now, let me just put this on screen for you now. You can see we've had over 6% rise this month. So lots of you UK investors are going to be pretty happy at the moment. Now, we're still away from those all-time highs that we did see in the market just a few months ago, but it is seemingly now going in the right direction. Just interestingly enough, let's have a look at some of those companies who are making those moves, and I'll pull this up now from Hargreaves Lansdown's website. As you can see, lots of mining and energy stocks, even beating down Vodafone now, finally showing some green shoots. Barclays there having a great bit of action. Lots and lots of big moves in just a single month. It is interesting actually when you think about it, like 2022 was that year of those kind of boring stocks, those energy stocks, those mining stocks, for example, that had a really good resurgence. Lots of dividend stocks especially had a really good resurgence in 2022 as the rest of the market and those growth stocks had a bit of a plummet. And now looking forward, be interesting which direction we go. For me personally, in my own personal opinion, it's always really just to own the entire market and let the market do its thing. You're always going to see swings of dividend companies or mining stocks, for example, have their ups and downs as they are commodity essentially, and the value of their stock really depends on the stuff in the ground and the stuff they bring out and stuff they actually get onto market, which really, that pricing they're not in control of. Whereas other companies, for example, can price their products really and have that pricing power depending on how much they want to sell it for, regardless of what they actually get from the ground, for example. Now, in the rest of the news, really, we are still talking about inflation and interest rates. You'll see at the moment, the European Central Bank have put their interest rates up to 4%. They're still trying to tackle those high levels of inflation across the Eurozone. And here in the UK, don't forget, we do have the Bank of England set to make the decision this week, and we are expected to see rates rise from 5.25% to 5.5%, which will be a record high for a very, very, very long time. And we think we're going to expect to see those pretty much remain stable from that point. Lots of people saying that this should be one of the last moves. But hey, as we know, predictions about these kind of things are pretty useless, so we'll see how we get on. Andrew Bailey has commented to say that we are nearer to that kind of rate rise plateau where we pretty much will hold things steady and see how things go. And just leading on from that interest rate news, it is interesting to think also how this influences the mortgage market. So although interest rates are set to go up, the mortgage market is actually looking to reduce some of their rates. You may have seen news stories that some of the headline rates are actually going to be reduced a little bit for like 2-year and fixed year terms, for example. And I think one of the things you always have to think about in the market like this is at the end of the day, the banks and the building societies, those people that lend money, are also in a competitive market. They want to lend you a mortgage, for example, so they can get those nice juicy returns. Now, the alternative for them, for example, might be to take millions and millions of pounds, or billions of pounds in their case, for example, put it into, UK gilts or US bonds, get their 5% return, or then they could lend it out to you as a mortgage for, say, 6.5%, for example. A little bit more risk, but they do have that house as collateral. And as long as things are stable and they think that house prices really will only go up and you've put a big fat deposit down, really, that's a good place to be. Because they are still competing for that business, and an extra 1 or 1.5% return on top of 5 is a lot of money, especially when we're talking about huge sums of money and just how big the mortgage market is. Now, just before we head into the portfolio itself, one more topic I wanted to talk about very, very quickly is exchange rate. Now, I do bring this up now and again because it does affect us as UK investors when we are investing for the long term. Now, you may have seen at the moment the pound is weakening slightly against the dollar, which does mean that your investments in your account, if all being equal, will actually grow. Don't forget that a weak pound effectively boosts the rates of those investments that are denominated in dollars, which most of the world is. When you think the largest equity market in the world is the US, with around about 60% of it being there based in the US. And even if you're investing in UK companies, if they do business abroad, this does affect you massively. Just for example, I'll just pull some random figures out. Let's say BP, for example, makes $100 million in profits and it's $2 to a pound. I wish, I know. But then you'd get, of course, £50 million in profits from that $100 million, let's say. And let's say next quarter it's the same. Again, they make $100 million in profits. Now they want to convert those back into pounds to report those to the UK stock market. And you'll see that if it was, for example, $1.5 for a pound, then now you'd see $66.6 million in profit. So there is a huge swing there. That would be quite an exceptional swing. So this is an interesting one to bring up now and then, because lots of people are thinking, they'll go on Google, they'll look at the S&P 500, they'll see that it's up 15-20% this year, they'll look at their returns and they'll think, well, why aren't my returns kind of reflecting those exactly, or my ETF isn't reflecting that? And one of the biggest things is those exchange rates to pay attention to. So do pay attention to that, and really the biggest difference, if it does fluctuate and if it goes in the wrong direction, will make and affect your investment, certainly that you've got at the moment. On the positive side, if you're making new investments, then a stronger pound is good because you're going to get more of those companies, but a weaker pound will be bad for you because it's going to cost you more to invest the same amount. Now, are there any solutions to that? Well, you can go down the route of buying hedged investments. I know some of you in the comment section will go on about these, and they can be useful if you want to kind of remove, or at least to the most extent that you can, that effect of the market. However, personally, from my perspective, I think one of the best things we can do really is just have a very well diversified portfolio. We're not US citizens, and we don't just trade in dollars. We do have pounds, and we do need to have pounds in our pocket. So we really want to spread that risk and not have everything relying on the dollar as much as possible. So really for me, it's like owning the world and going back to that good old philosophy, just owning everything. And then over the long term, if we dollar cost average or invest monthly or invest every 2 weeks or whatever we do, then really that will level itself out. There will be good times with exchange rates and there will be bad times, just in the same as anyone in the stock market. The way that returns will be good and sometimes they'll be bad. Okay, let's now log into the Vanguard account and see how we've done. Now let's have a look here. The overall portfolio value is 56,933 and 33p. I'll put up on screen now what it was last month because I cannot remember, so I'll have a look through my old video and put this up on screen now. I'll also convert it to dollars, so I know we do have some international viewers and I do like to kind of work out roughly how much this value is at the moment. Remember, I'm in just a single index fund. I'm in the FTSE Global All Cap Index Fund, the accumulation version. I don't receive any dividends. Any dividends of the mutual fund are automatically reinvested back into the fund, which is personally the way I like it. Other people may want dividends for income, and other people may want to manually reinvest their dividends. Just be aware on the Vanguard website itself, two pointers actually, is one, you never get an email if you get your dividends, which is quite annoying. You have to keep on top of those yourself. And secondly, remember, if you are investing in ETFs, on Vanguard's site at least, you do need to have the full amount of money to pay for that ETF. Whereas an index fund, you can reinvest your money regardless of how much it is. I think technically they do have kind of lower amounts, but you can definitely get away with investing, 20, 30, 40, 50 pounds, for example, if that's what you got as your dividend. Now let's have a look from a performance perspective and see how we've done so far this month. And interestingly, I always like to see, are we anywhere near these all-time highs? I think we're pretty close. So let's see, so far, 56,933. I think we still need to beat, yes, we're very, very close at the moment. Our last peak was in 16th of August in 2022 at 56,950. So we're extremely close now to those all-time highs, which is quite nice to see. Again, as a long-term investor, I'm not necessarily bothered, but it is kind of nice from a mental perspective to want to see that and actually see that the market is moving upwards, and your whole concept and philosophy of investing to actually make money is quite an interesting thing to finally see work in action. Now, we all went through a horrible 2022, and you can see, I think, the dip of my portfolio here. The lowest point was when the market was near its lowest on 20th December, back at the end of last year, at just 50,660, which is a huge swing, really, when you think about it in a very short space of time. If we just go through the month, you can see really what a swing we've had from the end of August, which was negative 800, to getting nearly positive 800 so far in September. Again, anything could change because we're still not all the way through. And that brings the cumulative returns now up to £3,458, which is quite interesting there. Now, as I say every month, the reason I do these portfolio updates is to really show you as an investor what you have to go through month on month, especially if you're newer, to really have to ride out those highs and lows, because it truly is a roller coaster. That cliche that investing is for the long term and anything can happen in the short term, well, it absolutely does. And I show you this every single month on my YouTube account. Now, I know we've actually gone through these months and you can go back onto my YouTube channel to see this happen, but God, back in 2022, we were really suffering. And I'm sure a lot of you probably lost your faith in investing and thought everything can get worse, but it didn't, and it absolutely could have. And things turned around and they got better and better. And really what you need to do there in that scenario as a long-term investor is stick with it. Now, don't forget, if you do want to get started investing, I do keep the links below to my favorite platforms that I use personally to invest, and you can get some free money in free shares. So don't forget to check those ones out. Help support you, and it does help support me and help things going as well on the channel. And just of that portfolio, here's how it's broken down. I do have an ISA, and then most of it here is in my pension. There's two things here. My ISA is something which I'm just going to leave at the moment. My brand new ISA is with InvestEngine, so you can follow that one along as another series I do here on YouTube. Now, the pension is just going to be set and forget, and really, I can top this up whenever I want. Remember, you can top up your own personal pensions. As many of you will know, this is a pension that I've moved from various employers and now manage it myself. So rather than having different companies manage it, I think there's some was with Scottish Widows, some was with Legal & General, and some was with another company, oh yeah, like Aegon or something, and now I've managed them all in one place. Now, one more thing worth mentioning, and as a comment actually that came up in a previous video, it's a really interesting one actually. When do you see this kind of compounding returns and compound interest that everyone talks about when it comes to investing? And I thought it was a really interesting point, because in the examples that we tend to give, and we kind of say, well, the stock market delivers 9 or 10% per year for the past 100 years. Therefore, you put in £1,000 or £10,000 and you do that for 20 or 30 years, you end up with X amount of money. Now, there's two things on that. As we know, firstly, the stock market doesn't work like that. Investments tend to go up quite a lot, also down quite a lot at the same time, and they average out at that 9 or 10% roughly per year, not excluding inflation. But very rarely per year do they get that straight line up. So, the way compounding works, there's not like a day, a week, a month, or a year that it says, right, the compounding's kicking in. The compounding is always happening, but the compounding can sometimes be negative too, don't forget. So for example, you can have a 10% and then a 20% year and then another 20% year, but then you can also have a negative 50% year. Now, the compounding really comes in with obviously lots of money going in the first place and consistently doing that. And then over the long term, for example, when you have 2 or 3 or 4 good years of a stretch, once you get a 10% and another 10% and another 10%, that isn't a 30% increase. That increases on a compounding basis. Couldn't work out in my head exactly what that was, but I thought it was an interesting point. And if you're using an index fund, certainly like I am, you won't necessarily see that in terms of, any income coming in. You don't get given more shares. Your value of that index fund will just grow and grow and grow as the value of the fund grows. Because effectively, you still have the same number of units or shares, but those shares will go up in value over time if the stock market goes up. Of course, the stock market can go down and will go down, no doubt, many, many times during that process. So I did think that was quite an interesting thing to kind of get your head around. There is no magic compounding formula that happens on a certain weekday, a certain month, or a certain year. You don't see that going in. If you did get paid dividends, for example, I guess that's more of a tangible thing. You can see a dividend get paid and reinvest and think, oh, that's my compounding, but it doesn't necessarily work like that. But it's quite an interesting topic to get your head around. But really, you have to kind of trust the process really as a long-term investor and get that money in and see those things happening. But an interesting one nonetheless. Anyway, thanks so much for joining in. I'll see you in the next video. And as always, happy investing.